I'm Valerie Escobar, and I'm a certified financial planner with Mariner Wealth Advisors. You're listening to Your Life Simplified, and today I have a guest, Joe Reynoldson, also a certified financial planner. Thanks for joining us, Joe.
Thanks for having me.
Awesome. Well, today, our topic are 5 financial decisions that could haunt you in theme with our Halloween coming up. And so first thing I want to do is give you a really terrifying little present.
Oh, gosh.
Do you want to describe for our listening audience as to what it is I just gave you?
Looks like a fuzzy pumpkin.
It is a little tiny fuzzy pumpkin. It's made out of wool. And what makes it so scary is that you see how there's like these little lines, like where I don't know, what do you call it? The creases, I guess, of the pumpkin. Mm-hmm. It's made by stabbing the pumpkin in those little spots. Yeah. So it is kind of scary.
Did not know that. Did you make this yourself?
No. Abby Foster's mom did, one of our colleagues. So.
Very cool.
Yeah, you should be afraid of her. But I did want to ask you, Joe, what are you afraid of?
What am I afraid of?
Don't pretend like you're not afraid of anything.
You're springing this on me.
I am. I'll tell you mine if you want.
All right, you go first.
Help. Okay, so what I'm scared of are flying cockroaches.
Is that a real thing?
Yes. So like regular cockroaches are disgusting, but you can kind of project where they're going to go. But flying cockroaches, yeah, they're going to end up in your hair.
I didn't know those.
Now you have a new thing to be afraid of for you.
That's funny.
So your turn.
That's funny. My biggest fear is probably inflation.
Joe, that is so nerdy.
No, I'm kidding.
Are you afraid of heights? Are you afraid of
not really, and I feel like I have
public speaking?
I feel like I have to come up with something.
Yes.
Because I can't just say, "Oh, I'm not afraid of anything," but I'd say, yeah, public speaking is probably up there. So. Okay.
All right. Well, you'll have to think of a better one by the end of our episode. Right, a real one. But today we do want to focus on some financial fears or things that we experience probably with our clients, some decisions that they've made that maybe have haunted them. And so the first one that I wanted to talk about is losing your cost basis. This is a big one, especially with Roths. I've noticed is that when somebody wants to take money out of their Roth and for whatever reason, they haven't reached 59.5, and they want to do that. If they don't know the cost basis, which is the amount of money that they put in with that pre-tax money, the after-tax money, so money they've already paid taxes on, if they didn't keep track of that, when they go to pull it back out, again, you have to pay the tax. So double taxing is not fun. And I think to clients, they've found that to be really frustrating because they thought it was this easy place to get money from. So don't do that. And I mean, that applies for so many things. Have you had other clients lose cost basis?
Yeah, I'd say it's pretty applicable if you have like legacy assets. So whether it's a older client or they're with a custodian from years back where the custodian wasn't required to keep track of the cost basis.
Yeah.
Sometimes it gets lost if you transfer those securities to another custodian. And that can be not an ideal case if it's a security that you eventually want to sell, because then you don't have the basis information for the gain calculation.
Yeah. Yeah. And I feel like that becomes more of a nightmare for us because we're helping the client figure it all out. But yeah, it definitely turns into to kind of a mad hunt for figuring that out. What do you got? What's another financial decision that you've noticed?
So something I've noticed is clients that would chase thematic investments. So these are more macro level trends in the economy, whether it's renewable energy or something like that, to where they see a certain stock or sector down 50, 70, 85%, and they automatically think, oh, there's got to be a reversion to the mean. Why don't we just buy this and wait for it to come back? And it's actually not always the case. You can look, there's a large list of stocks that actually haven't returned to their .com bubble peak. So mid or early 2000s, they still haven't returned to that peak. So it's just understanding each market cycle has different fundamentals behind it and understanding why you're in investments and not just buying something because it's down 50, 75%.
Yeah. And I've also noticed like chasing, I don't know, like the hot new thing. Like I remember when cannabis stocks. Yep. Do you notice that?
Yeah.
That lots of people were just like, oh, like I somehow have this inside track. No one else has thought about this.
Yeah, it's understanding the fundamentals behind that and the risk. The regulation risk is one. And then a lot of time with those longer dated companies like cannabis, the longer dated earnings, those stocks usually tend to be more volatile.
Okay. Yeah. So. Awesome. Boring can be really comforting and great sometimes. And so that would certainly be one of them. The second one, and I think I have a trend on my things, is forgetting required minimum distributions. If a client forgets to take their RMD, the penalty is 50% of that. And so that can be obviously, if you have a $10,000 RMD and then all of a sudden you owe 5,000 of that to the government, that can be really painful. And I've also seen this happen when somebody has both like an IRA and then they have a 403B and different types of plans. And for some reason they thought, well, for good reason, it can be really complicated. They take their RMD for the 403B out of the IRA, and that, again, causes a big issue for clients on that side. So.
Yeah. I'd say that's something that's not necessarily common knowledge, that you have to kind of aggregate all your IRAs together to then calculate your RMD. So
right.
Something important to keep in mind.
Yeah. Yeah. And so again, that becomes something that we try to help clients navigate for sure, so that they're not ending up holding the bag for that. So let's see. Tell me about another fear that you have that's for real this time. Financial related anyways.
Yeah, the financial related fear.
Yeah.
So we talked about this earlier, but inflation, obviously a fear. I'd say a mistake a client could make would be leaving their cash,
just
kind of sitting in cash and staying out of the market and letting inflation eat away at your purchasing power.
Right.
So.
Yeah. And that could be, that's so funny because it's a fear that feeds on a fear, right? You're afraid of losing.
Yeah.
You're afraid of losing. And so you're just like, I'm going to wait for, I don't know. Sometimes it's like, I'm going to wait for the market to tank. I'm going to wait for this election. I'm going to wait for, I don't know, a certain legislation to go through, because that's when the perfect time is going to be to get in.
Yeah.
But then.
Well, yeah, if you look historically as well, equities and real estate have been the best inflation hedges. Mm-hmm. And then now kind of the silver lining with inflation is that real yields are starting to rise and be positive. So whether it's equities, real estate, or fixed income, or a combination of the three, really, they're really doing something is better than nothing in terms of retaining that purchasing power.
Yeah. Yeah. And I think that's such a huge detriment for clients, is that when they're trying to time it, right, and decide, okay, which is the best time and which is the best equity class to get in, they ended up like that analysis paralysis is what's actually damaging them in the long term.
Yeah.
And so right now, when we have inflation, I guess, it's such a hot topic right now. What are you seeing with clients that they're really frustrated about it, but, like you said, there is silver lining. And so, I don't know, what kind of new purchases are you seeing clients kind of getting into right now?
I say it goes back to the real yields I was talking about. So now that we're able to earn 3, 4, 5% in fixed income, that has a spot in a lot of portfolios. So a portfolio doesn't just have to be equities, real estate, and high yield fixed income. So the more aggressive, higher risk fixed income. Now we can kind of be a little more conservative with those allocations and get a meaningful yield.
Right. Yeah. And that has been, we're very focused on the downside of inflation, but we try to remind ourselves, if I had a client, I mean, it's been a long time, but if you had a client that had bought a really long CD, 30 years ago, or a T-bill or something, it's just paying these amazing returns or yields. We're finally starting to be able to see that kind of environment again. Yeah. And so being afraid of inflation, being afraid of the market in general, I think is more detrimental to the client than just saying, you know what, buy, hold, not look, to some extent, can certainly be something that's impactful. Okay, so last one, the fifth one that we're going to talk about today is not updating beneficiaries. And this one, and again, I guess like everything, it's for me, I'm a very forgetful person, or I tend to be. Maybe it's because I remember stuff from my clients, I write stuff down, but when it comes to my own life, like I can't find my keys ever. But for beneficiaries, remembering to update your beneficiaries, it's something that is so easy. Just to be like, okay, I need to review these, who's my beneficiary on this. One example is that I had a client that, she inherited some assets from a family member, who had removed all of her beneficiaries and decided that because she couldn't decide, right? And she's like, so I'm just not going to leave it to anybody. I have time. And, you know, everybody always has time until they don't. And so it was an IRA that this client received or inherited. And when you don't leave a beneficiary, and if you are of RMDA, so the original owner was in her 80s or something like that. So now the new person, the estate effectively earned or inherited it. My client was that person who eventually got it once it went through probate, but now it had to be, the RMDs had to be calculated based on the original owner's age. Right. And so now all of a sudden where it could, I mean, this was old law, right? So it could have been stretched over her lifetime. Instead it was stretched, and she was like in her 20s. It was now stretched over the lifetime of an 80-year-old. So these were just huge distributions. And so, you know, my client was very adamant that her relative was just a wonderful, you know, investment guru and all of that. And in the end, it kind of undid itself because it's something pretty basic. When it comes to that. Have you noticed beneficiary issues coming up for your practice?
We see it a lot of times if we have a client that gets a trust and we need to update it to a trust, or whether we were talking about this earlier to where it's kind of dark, but if you want to cut someone out of the will, whether that's a child, some states have laws to where you have to actually have that in the trust document. So making sure just your wishes are met in that trust document, and then eventually putting that in the beneficiaries is important.
Yeah. And trust, I mean, that's, I guess, one last note I would say too, is that getting your trust written is nice, but it's not really meaningful until you fund the trust. And you fund the trust by titling things or putting a beneficiary designation so they go into the trust. So again, remember all these things to remember to do are super important. So on that, we'll go ahead and close. Thanks, Joe, for joining us today.
Thanks for having me.
Yeah, and you've been listening to Your Life Simplified. Be sure to subscribe wherever you are listening, and we will join you next time.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.